The Oneida tribe received monies in 1967 from the Indian Claims Commission. It's like 1.17 million. But when we received the monies, they came with some strings attached, I guess, and one of them was that the funds needed to be put into a trust fund. And it was presented to the General Tribal Council, a lot of discussion as usual, and it was decided by the General Tribal Council that forming a trust committee to manage those funds would be the best route to go. It's to take a set of funds, manage them in a way that they're going to grow through investments. If you had $1 this year, next year you want to have $2 from that investment. It's a document for the management of those original 1.17 million funds from the Indian Claims Commission to be managed on behalf of the tribal membership, because the monies weren't distributed. They were held intact in that fund, and then it was up to General Tribal Council to determine, based on the advice of the trust committee, how to distribute those funds. Oneida worked with the people in Washington, D.C. who were drafting the language in determining that a revenue allocation plan needed to be submitted by each tribe whenever they did an allocation. So that could have been annually, it could have been quarterly, whatever that plan was going to. It had to be approved by the Gaming Commission in Washington, D.C. They look to Oneida. And if Oneida does it the right way, then everybody else has to kind of follow. It's really there for the protection of the tribe and then the miners. Well, they have the fiduciary responsibility to maintain or see to the growth of those investment funds. It's a really heavy responsibility because it means monitoring activities in the financial world nationwide, watching the Dow, watching the NASDAQ. You have to know about that stuff. And it's something that not all of us do on a regular basis. The trust committee has to do that every single day.
The Miners Trust Fund never held the Standing Stone Fund as an investment. The time horizon on the Standing Stone Fund is not appropriate for the Miners Trust, which has a much shorter time horizon than the Elders Trust. The Elders Trust is supposed to be perpetual, so that makes the Standing Stone Fund appropriate for the Elders Trust Fund. Each Miners Trust beneficiary receives a quarterly account statement which reflects their market value for that quarter. And in that mailing is also a fact sheet that shows the performance for their trust portfolio. And then we also have annual statements that are mailed out to each Miners Trust beneficiary. The Oneida Trust Enrollment Committee was given direction and authority to manage all the tribe's trust funds and ultimately the endowment funds also through General Tribal Council resolution and laws and policies. And as part of the Miners Trust team, we have the ultimate responsibility with the committee, the staff, which reviews the portfolios on a monthly basis. We also have other entities helping us because there are some functions that the tribal departments were not able to handle. The Trust Committee reports the performance information to the Business Committee on a quarterly basis, and then we also report overall to the tribe on a semi-annual basis. The Miners Trust account's market value is not guaranteed as stated in the per capita law. It's difficult when you're invested in the market to tell people what the amount's going to be when the funds are claimed. So we don't do that. Our goal is to preserve principal for the older miners who are potentially getting out of the fund sooner. And then we have a portfolio for the 0 to 14 age group. That fund is managed a little bit more aggressively because they have a longer time horizon to be in the market. The Miners Trust Agreement is formally known as the Per Capita Trust Agreement, dated November 1994. We just refer to it as the Miners Trust Agreement today. There's a lot of governance in that agreement signed between the Business Committee and the Trust Committee. Since the tribe uses gaming revenues for per capita, we must comply with the Indian Gaming Regulatory Act. So there are stipulations in there that help take care of the minors and legal incompetence, people who need help with their financial affairs. Then we also are in compliance with the Memorandum of Agreement, which is signed between the Business Committee and the Trust Committee. And as I mentioned, several DTC resolutions that were established in the 1970s. The people who set up the trust originally was very smart. They were forward-thinking, and they wanted to protect principal. They wanted to make sure the fund was perpetual. And it all started with a scholarship plan and then the Elder Per Capita Trust Fund. We work very, very hard, and we try to respond to inquiries, expediently, because we know people get a little upset if they don't get an answer. So we're very quick to reply. But we do know also that no matter how much correspondence we send out, how many mailings, how many postings, we're still not reaching everybody. So there's a lot of people who don't know a lot of this information. We understand that, but we'll keep trying.
Oneida Trust Enrollment Committee, on a monthly basis, reviews the performance. We give them updates on any distributions going out of the trust fund, making sure that the miners are paid the per capita when it comes in, and so forth. A portfolio manager, Matt's Trillium Asset Management, out of Boston. They have about $2 billion of assets under management. And what they do is they decide on what stocks and bonds they want to put inside of a portfolio. So for the miners 0 to 14 portfolio, there's more stocks, and for the miners 15 plus portfolio, there's more bonds in there. Equinox is based in Atlanta, Georgia, and they're our fund accountant, and they are responsible for doing all the accounting work for the miners portfolio. So if there's an expense, like we have to pay a money manager, they track that. When we get income, they also track that income into a portfolio, and then they calculate it out to a per share basis and the statements that we send out to the miners on a quarterly basis. The Northern Trust Company is a $6.2 trillion assets under management custody firm based in Chicago, Illinois, and they're responsible for maintaining the assets of the portfolios, the stocks, the bonds, cash, and so forth that makes up the portfolio. They make sure that if interest is paid off a bond, it gets credited to the account. If a money manager decides to sell a stock, they take care of that transaction. And they also do our performance measurements for us on a monthly basis. The bank helps us with the distributions. So once Equinox gives us the information as to per beneficiary or per miner amounts, then we send all the money to Bay Bank, and then Bay Bank either sends a check out or ACH the money to an account that the beneficiary is designated. Callan is a consultant, and they're a third-party check on performance and also a measurement of the money manager. Is the money manager doing a good job? Are they taking excessive risks in managing the portfolio? They have a database that's their own proprietary database that they can measure our money manager with their database. It gives us perspective of how we are performing. They really have two separate portfolios. One is based on anybody the age of 0 to 14, and the other one is anybody 15 and over, and that change takes place on September 30. So if you turn 15 somewhere between October 1st and September 30th, you'll be in the 0 to 14 portfolio for that year. But 9/30, and that money will be moved over to the portfolio.
Mm-hmm.
The 0 to 14 portfolio is a little more aggressive. We're trying to outpace inflation. We're trying to build up a nice nest egg for the miner, and so we have more stocks, some bonds, and a little bit of cash in that portfolio. The 15 plus portfolio is really designed to maintain what they've earned and gained in the portfolio. We don't want any stock market surprises to impact it.
Mm-hmm.
So it's almost all bonds, some stocks, and a little bit of cash. And that's called asset allocation. And that's how we manage our risk, so that a portfolio can have a little bit more risk or a little less risk. And that's how we manage that. It's a real great benefit for the miners to have age-based portfolios, because on the one hand, while they're young and they have time on their side, they can take on a little bit more risk and try to earn some more in the portfolio. But once they turn 15, we don't want to have that risk on the portfolio. Even bonds have risk, but at the same time, the risk is less. And so we're just trying to maintain what they've earned and give them a nice distribution when it comes.
Okay.
We get the question a lot, how much interest do the miners earn? And they do earn interest, but it's not like an interest-bearing account or a savings account. This is a portfolio of stocks and bonds, so there's no guarantee of an interest rates like you would get an money market or a CD. This is an investment portfolio. So it is a range, and but it's not guaranteed. But month after month, they get the miners' trust performance measurement against an index. And then index is just really a basket of stocks. One of the more famous indexes is the Dow Jones Industrial Average or the S&P 500. And so we measure the miners' portfolio against those indexes. We also measure against a benchmark, and the benchmark is more true to what the portfolio is, because remember, the miners' trust funds has stocks, bonds, and cash in the portfolio. So our benchmark will have stocks, bonds, and cash. And that's how we measure, make sure we're doing a good job. So the Trust and Enrollment Committee created what's called the Investment Policy Statement. And it's a document that helps guide us in our decision making, so we don't get emotional decision making. If the miner's portfolio were to drop quickly, we might be inclined to sell and move to cash and do something rash. This investment policy statement says we maintain a certain allocation to stocks, bonds, and cash. And that just kind of keeps us in the right mindset to make good decisions for the long term. We've had a lot of success. There's a claiming process. You fill out a form, you let us know, and there's a deadline to it. And so we pay out miners in October. If they're late with their paperwork, we do what's called a supplemental payment in April. And so the money stays invested until March 31st, and at that point we liquidate the money that they're claiming. So for example, we just had some miners claim that had $21,000 put into their portfolio, and they were able to claim over $28,000. So they had a nice $8,000 gain.